Traders, what's going on? Jamie Saettele here. It is the Midweek Strategy Webinar. It is May 2nd, 2018. Jeha says, good morning to you, Jeha, or afternoon or evening or wherever it is you may be. Everyone else, let me know that you can hear, that you can see. AV is good. Okay, great. Peter, Pooja, what's going on? All right, so we got a chart of the dollar index here, weekly chart. The dollar's on the warpath, I guess would be the kind of the best way to explain it here. And I got a lot to go through today, but kind of think about it this way. We're gonna look at levels. So I want to point out some big levels in various, various markets and various cross rates, et cetera, gold, silver, crude oil, some indices. And then I want to kind of talk about how I would trade, or how to trade, or how I'm looking to trade some of these things within the context of these levels and the recent change in behavior that we've seen here with the dollar. So you've got, we've long talked about the positioning issue, specifically as it pertained to euro dollar for a while, and more recently British pounds and also crude oil, right? Positioning in crude oil is just insane with the amount of longs, spec longs that are there. So we're seeing, obviously, this is what happens, right? When the market turns, right? It's like the positioning doesn't matter until it matters. I know that's a really simple, kind of dumb way to say it, but it's really quite true. And with dollar index here, the major levels that I'm going to point out, we're nearing actually one of them, and that is the 52-week average, okay? And that's going to be pretty much in line with former support. In fact, this is actually in May of 2015, believe it or not. So if you, for some reason, went into a coma in May of 2015 and woke up today, you would actually think that the dollar didn't really go anywhere. And that would partially be true, but obviously it's not really true because the dollar has gone all over the place since then. That level, again, 93.13, so it's a biggie to pay attention to. How far do I think that this rally extends? I actually do think there's a possibility that we go through maybe all the way back up to this parallel in the 3-year average at some point, right? You're going to have other levels prior to that, okay, that are going to influence, and I would expect to get trades off of those levels. And again, we're very close to one right now with that 93.13 level is a biggie. And then you have the median line, which is going to be pretty close to 94.08, which is going to be the low from August 2016. And then you can see, if you just zoom in, that was a level quite often actually last year, last August, last October, and then actually throughout November and December. So those are the two big spots to be aware of, or probably over the next month or so. All right. We'll zoom into kind of more I don't have a really great structure on the near term for DXY. I do have a pretty good one, I think, for US dollar, right? That is, oh, wait, hold on here. Are we just looking at not log scale? Okay, here we go. All right, so yeah, 93.13, and then the median line 94.8. So those levels don't really change, but you want to be aware of those. Okay, let's go to US dollar, which of course is going to be a bit different with Aussie and everything else in there. Weekly chart, do think that the big level is, it's actually much cleaner here for me. The big level is going to be 12,000-ish, 12,000, 12,030. That is your 3-year average. And you've got great slope up there, combination of sorts. So, drawing in your channel from the 2011 low, the 25 line from that structure, which was support back here in September of last year. That's going to come up here, and I'd be looking for resistance there. And it was kind of, it was also, if you just looked, it was really where we started to accelerate lower from. I would also pay close attention to the fact that you've got these down sloping parallels here, right? So you have a parallel that's off of the November high, and then this is the 25 line from this fork. And remember symmetry, the 75 line was support back in January, didn't really go anywhere for a while until just 3 weeks ago when it started up, but that's going to be 12,000, 12,030. So while the very near term picture, obviously for US dollar, broadly speaking, seems to be extremely stretched, and I am looking for, of course, I have been looking for really ever since here, right? Some sort of a reaction, something that lasts longer than a day. And that's all we've had so far, is something that lasts basically a day. But I am looking for a pause in, excuse me, in this move. And I do think the best spot to look for support, and it seems a big one from here, but we've gone straight up for 3 weeks now. So, respect, I guess, the potential to get a pretty decent drop. This fork here, US dollar, this is linear scale. For whatever reason, linear tends to work a lot better with US dollar. Would intersect, basically Friday, so maybe you get something with NFPs too, or you get a strong or a weak dollar move or something. If you did, it would come right into here, which is the top side of the March, November, December trend line, right? So clean trend line, also bottom of the channel. Also, you hit 3 points. So the textbook folks would say this is indeed a valid trend line, right? And we are on, of course, the 75 line from this fork here. And horizontal levels, you've got the year-to-date high in USD right up here at 11,895. And then you've got the December 1 low, which is going to be at 11,911. Okay. So all that said, here we are, FOMC today. I'm not a fundamental guy, analyst, whatever. I actually do think, though, that, look, you've got the new guy, Powell. The swaps market's pricing in like 3 hikes at the moment. I don't know. If this being a new Fed, and I'm not sure how much this guy really cares. Like, Janet Yellen was the most dovish Fed in the history, right? That doesn't mean a whole lot with respect to, your day-to-day movements. But as far as, coming up on what he's going to say, I don't know. I wouldn't be surprised if he telegraphed 4 hikes. Just, since the equity markets have stabilized, you've got rates shooting up like crazy, right, across the curve. 2s, 5s are just through the roof. But here's the thing. I think if that happens, I actually think that the risk is that interest rates go the other way, and that you get a sharp dollar pullback. With the rate market, you've got just an extremely crowded people short notes and short bonds. So again, I would not be at all surprised to see a strong tick higher in the bond market, and in the notes market, sending yields lower, sending the dollar lower, at least for a much needed pullback of sorts. Anyway, all that said, we're kind of at resistance now. This is, I think, a chart that we had. I think I had it last night. I'm not positive, but either way, you know, I lean towards being dollar bearish here. Obviously, you could get a quick spike going into the meeting, and if that happens, great. I'd look to fade it. I guess the question we want to ask ourselves right now, with a couple hours going or 3 hours left until the meeting, is where would be the potential, where might be the best place to fade, right? Yeah, as we know, the Nikkei, the dollar yen is always a pretty good candidate for a rates move, an FOMC day. So I think that's a place to watch, and we'll go there in just a sec. But as it is now, know these levels. All right. Let's go to Euro. Okay, so Euro. So this is the log scale daily and the one we've been following for a good deal of time. Very interested to see how today's close looks, given these are the parallels, and you know, it talked about how many of these parallels, you know, how many times the market has traded on these parallels, right? Sometimes with precision, okay, like the top here, support or resistance and support, and then resistance again, actually just 2 months ago, and support here, and then resistance here just 3 weeks ago, and then support right here before the breakdown, right? So we're at the next one. This is the next one. And, you know, if we can turn up and close above here, you get the 200-day average, you got the 120.02 is the yearly open. I think it would be good for a move probably back to the median line, 120, 150, which puts you on the former low, former support, right? Look for it to provide resistance. So again, I lean towards coming in here with a fading bias, right? Or looking to fade this dollar euro drop, looking to fade this dollar rally. This is, just noted this on Twitter, but the 1127 high is 1960. We're at it as I speak. And then 1916 is actually the year-to-date low. And that's going to be a spot that if you do take it out, again, I'd be leaning towards fading it, right? Now, like, it's very difficult for me to, you know, sit here and, or when all this is going on, you know, when I give out the trade setups in the SB swing update, right? Those are ones where, with an order, those are ones where it's like, I think we've turned and I'm looking to buy a level on a high volume level or something, right? Or there's a tradable low in place or whatever. That's obviously not the case here because we've been sinking like a rock and Euro's just, you know, one-way train. So I'm looking for capitulation, right, on Fed. You know, I'm looking for an emotional bottom. I am, you know, can do my best during the heat of the moment to send out a tweet saying like, oh, here, this is it, right? But as far as putting in an actual trade order through Twitter or something, that's going to be a little more difficult because the situation is so fluid, right? So what I would want to see would be if, you know, the swing update trade, as you know, would be like something like if we, you know, you get the capitulation low and then you come up and then, you know, then I put in an order overnight to like buy it like down here, right? So just so you know exactly what it is and how this all works, but most of you probably do. All right, let's go to Euro a little bit more. So you see this line, this downward sloping line coming in here. That is actually from all the way back in 2008 in this parallel trend line, right? has been at times precise in its, identification of a pivot. It's an important level. Essentially, you are, coming off of, the much bigger top from a horizontal level. But when we look at this, it was pretty close to being resistance back in September. And then you traded around it, of course, back in early this year. So it just kind of adds to the evidence that suggests we are at some sort of a point to pay attention to, okay? Now, I want to bring in a bit of a different look here, okay? Now this might look somewhat familiar. This is the, the counting of the bars where you're trading between 52-week high and low. But we also have here, this is the blue line is the 52-week closing high. The red line is the 52-week closing low. And the middle gray line is the midpoint of those lines, okay? Now, what if we were of the mind, or I am of the mind that the dollar is in a broader, call it more cyclical downturn, right? Which would mean the euro is in a broader, more cyclical upturn. Well, think about this. We haven't even made it yet to the midpoint of the 52-week extreme. I will give you some great examples of this happening within large moves. So back in the early 2000s, had the big run and the pullback, and guess where the pullback stopped? At the 52-week midpoint, based on closing prices, to the tick, okay? It did it again over here in 2004. You actually never even got to that point in the 2006 to 8 rally. Even in downtrends, this is the financial crisis, and the ensuing, short covering rally actually sent you up to the midpoint of the 52-week close. You spiked through it, but you get the idea. Even last year, or not last year, but 2015, the initial spike, right? Initial recovery off of the panic lows from March 2015, that sent you to the 52-week midpoint as well on the downtrend. Okay, so I don't think we get there, soon, but who knows, given what's the nature of this move. Again, I think we bounce first. In a perfect world, we bounce first. We can be long for a bounce into this low 2140 or whatever, 2150, call it 121 to be safe. And then we try to get short for that and take it down to 1690. Okay, that's kind of my game plan of what I'm thinking. And oh, by the way, 1690 is essentially the 2015 high at 1712. So a lot of really good levels here, right? So these are the levels. Now, how, obviously I touched on it, but trading within the context of those levels. So with that, I'm using the fork here, right? And hopefully we do turn up here like today, because otherwise this like isn't really useful anymore. But here's the 2150, here's the median line. If we can get some sort of a rip back up into here, that would be ideal for the short. So I'm not predicting that will happen. I'm just saying that's what I'm looking at. That's what I'm looking, that's what I'm thinking could happen in my mind. That's all. Mentally preparing myself for it. The other thing to draw in here as well, of course, is your former corrective channel. And that's going to be that one, which we actually hit this morning. So in order to be, I guess, call it, have some sort of confidence that we're putting in a tradable low, you need to get back above this channel. That's a really important point. All right. Otherwise, you're really fighting it. Really fighting it. Okay. All right. So I'm going to leave that, but that's the idea with Euro. And I like that 52-week midpoint thing. I think it's kind of an interesting point to make, in that, look, the Euro's getting murdered, but at the end of the day, we're still, I think, in a cyclical dollar downturn. I've made the point that the long-term dollar cycles, they tend to last for 7 to 9 years, and we are in year 2. So after all is said and done, I think there'll actually be a great opportunity to take advantage of whatever the Euro gives us in terms of how far it goes to the downside. All right. Let's move to, I actually want to bring in another weird thing here, and that is with dollar Swiss, which I guess you could kind of argue has been the leader. Because we started kind of, we turned up here back on 216, and it didn't really consolidate, it's just kind of gone straight up. So with dollar Swiss, the red dots here, you're looking at the number of days that you've spent on either side of 30 or 70 on RSI, right? So we're counting the number of days that we've been below 30 in RSI or above 70 in RSI, and we're actually at 9 days. So we've spent 9 consecutive days above 70. That's fairly rare. In fact, the last time that happened, believe it or not, was right here, the SMB debacle. So that was the SMB right here. You had 9 days above 70, and then you had a bunch more days below 30 after that thing happened. But it was day number 9 that was actually, right here with the low. So going back in time, you can see it is pretty rare. This was a top 9, 10, 11, 12 days into the low in 2011, and the SMB intervened again here. I'm being told that Euro charts are still showing. Can you guys see the dollar Swiss chart? Okay, good. It might just be a bit slow on. So Jorge, what you're looking at here, just in case you missed it, we're looking at the number of days that RSI has been either above 70 or below 30. Okay, and the red dot indicates 9 days, and as you can see throughout history, 9 days is a pretty good indication that you are, to put it lightly, pretty darn extreme. Okay, it doesn't happen a lot. So yes, especially in recent history. So I'm looking for a pause in this move. This might be the best chart to suggest that we are due for a fairly sharp reaction or shakeout on this, in this dollar move. Okay. Let's go to cable now. All right, so British pound, we actually have a bring in this one actually. All right, so we've got a monthly J spike that occurred. Let me bring that chart up for you so you can see it. I mean, here we are we're on day 2, right, of the new month. So this is still appropriate J spikes, when I look at them on a monthly chart, you can do 12 or 18. This is an 18, so 18 months, right? Year and a half. You can see all the J spikes that have occurred, right? Low, low. The last actually bearish monthly J spike we had was all the way back here, and that was the month of November 2007, which was the high. Okay. Back in history, you've had some good ones, you've had some bad ones, right? This was a good one. This was the so-called Soros breaking the Bank of England, which was, I guess you could call it a kind of the whole move right there, but then it actually continued lower. You had one here in October 1998 and back here in November 1980. All right. So just that's good to understand, I think, from the standpoint of it's happened from a pretty long-term resistance area. I mean, just look across the chart, right? So I don't think there's much of a case or argument there that, you know, there's the potential that we may have made some sort of an incredible top in the British pound, right? The question is trading it, of course, because what are you going to do? Go short here and put a stop at 600 pips? I don't think so. So what we're looking at, we could consolidate here again on this is the new bearish fork. Okay, there is validity to this. You have reacted to it before, so I offer, you know, I do give it some, you know, some validity. You also have the possibility that you do flush out and trade to the year-to-date low, which would be 134.57, and that would be what we, you know, this is our new angle to work with on the upside. Okay, it's simply the lows from, and again, this is going to be on log scale. These are the lows from 116.17, so January and March of 2017. This is the original slope, right? The center line for that has been all right. You know, you consolidated above it here before you took off on the upside. If you probably draw it off of this one, it'd actually be, there you go, that's better. So actually, if we draw it that way, it's support. The top line here, which is in red, you can see has been resistance and was actually then support back on March 1st. And at some point, this could come back into play for resistance, but I'm not too worried about that right now because the first thing I would do is I'd be looking to trade this. This is the zoom and retest strategy, right? Where you tank below the median line, then you zoom back towards it, and when you test it, then you can short for resumption lower down to the lower parallel. Okay. So again, support levels, there's a pretty wide zone here, but I would call it 34.57 to 34.99, which is the yearly opening price. So year-to-date low and yearly opening price. If you wash out into there, looking for a bounce, if you bounce from here, then resistance is upwards of the median line. Again, at this point, that's above 138. So, you know, you've got a good ways to go. But those are the levels for cable. Dollar yen. So this might be the one that, you know, I think we should be paying very close attention to heading into FOMC. Is, you know, oftentimes it is a big mover with FOMC. You get a pure move out of it because you get a rates move. And the level that I've got, if we bring up the long-term chart or longer-term chart, we're kind of there, really. You know, give it a little more room. 110.20 to 110.50. Right? That's right here, 117 low and the February high. 200-day average is in the zone, square root level at 110.50. And then you can see this line that's coming up. There was influence back here on it in, I guess, February. Support here in 2016, and that line is drawn all the way off of the 2011 low, okay? And again, this is log scale. So 2011 low to Brexit, and that's the line. and we're pretty much there. So my best idea going into FOMC, from a levels perspective and kind of I guess a making sense perspective on how the market sometimes trades around these things, is to look to fade a spike move in dollar yen up into 110.50. 110.25 to 110.50 is the zone, and I would look to take it down. You can see it right here. This is a shorter term chart now, so you've got this upper parallel up here too. I would be looking to, probably get out of it on the quick move back down to like 109.20 or so, which is the center line right here, which was resistance back here, and you kind of consolidate around it for this recent run. Okay. So that's just kind of a news trade idea, but that's what I'm looking at heading into 2.5 hours from now. All right. The Australian dollar. Let's look at commodity currencies. This is the weekly, kind of on the bounce level, right? 75, with the next level not being probably till 73.80. But here's what I'm wondering. I mean, look, you have to say, you can't make up what you want to see, right? You just kind of have to say, what's the market doing? What's it done? Well, what it's done is it's traded higher since January 2016 in an overlapping fashion, albeit a corrective fashion. So what does that mean? Is it this simple? Did we just finish a giant wedge, right? Did we just finish a giant bearish wedge, and is the Australian dollar about to just absolutely get smoked? It is a distinct possibility. In fact, I see it as a probability here, of decent magnitude. So the way I'd want to trade it, again, maybe I'm trying to be too picky, but if we can get a move back towards the underside of this trend line and test it, my Lord, that would be the best thing in the world, wouldn't it? Because what you'd be doing from that point is looking to short and take it essentially, I mean, we might be targeting this line. Your target for this is simply to test the low, so the January 2016 low, but I'd guess that you probably flush it out pretty good at that point, right? You can see this level. This would be the one that I'd be looking at probably the most down here. So that's getting ahead of ourselves because we're talking about 1,000 pip drop from here. But here's the daily, same lines on it, right? We're at this center line, median line, and if you get a rip, we're looking at the underside of that's going to be in line with the former lows. So this is the cleanest, probably longer term position type setup that's out there from the way I'm looking at it, and I would love if we can get this going. So get some consolidation, get a quick move higher up into 76.40, and then fade that for resumption of this massive bearish wedge. At least that is the setup. Okay, Kiwi. Actually have a level here in Kiwi based on a few things, but you've got this. This is a chart from last night, right? If we pop here, we get short-term level at 70.76, which is the week open. The better longer-term setup is eventually to get back into the median line and sell that. But I am looking for Kiwi to get a bounce off of here. See the pink average? The pink average is the 3-year average. That's where we are right now. It was resistance before, and it's been support before, and it's been really big support before. So we're at an area where I think we should be looking for a bounce. Again, that bounce is probably going to be a sale, but all I care about here is looking for the bounce. At this point, this setup and the levels are not as clean as Aussie. That's kind of flipped. It was the opposite case a week and 2 weeks ago, but just know that you're at a level here from a short-term lower parallel and a 3-year average. So, you know, favoring a bounce in Kiwi. Dollar CAD. We are continuing to just trade essentially between, you know, these are the channels that go all the way back to 2012, 13, 14, and I don't want to complicate it. Let's just stick with it. So we go to 60-minute chart here. We're either complete with 5 up, or we got 1 more to go on a spike in FOMC, in which case, if you do, you probably take out 29.40, which would be the high from April, and then you pull back. And the pullback buy level is, you know, the same one that we've been following or looking for a while, which is the actual trend line from 2012. And that's going to be on your 20-day average, and that's going to be in the 27.20 region. So potential for 1 more spike and a pullback. This is also a pretty good candidate, in my opinion, for a for a FOMC trade, especially if you spike up through 29.40. I'd be looking for that to fail and then come back. Okay. So those are all the currencies, the major currencies. The ones that heading into FOMC today that I'm most interested in for setups are probably the dollar yen 110.50 as a sale, dollar CAD maybe 29.40 something as a sale, and euro, right? I don't know if we get down to the euro year-to-date low at 19.15, but if we do, I'd like to see that fade as well and take that higher. So that that is my game plan. See a good level here at 29.15. We've already run into, but I'm going to stick with the idea that we, basically get 1 more push and then wipe out and tank. And if we don't, if we just tank from here, then this is still the level to look for support, which is 27.20. Okay. All right. Let's go to some gold. Let's go to some crude oil. Actually have some interesting stuff to look at with the ratio of gold and crude oil. And then, of course, we will look at some indices, although I do not see Mahai in here today, and he's usually the one that really wants to look at indices. So, Mahai, if you're watching this later, then look at indices for you. All right. Gold. Start with gold. Okay. The gold chart from the low seems to be charting a bit better on arithmetic scale. You can see the median line. We failed there just on 411, so we've now retraced the whole thing from here. This to me looks like a flat A, B, and then we're dropping in a C wave right now. So 1, 2, 3, maybe a pop in 4, drop in 5, and then I'd be looking for support at 12.95, right? That was resistance back here in 2017 twice, April and June, and then it was also resistance in November. Essentially, I'd call that the breakout level because that's, we broke out there at the very end of the year and then come back to it. I'd watch for support. I'd be looking to turn bullish gold for a pretty good setup here at 1295. I like the pattern too, right? 3 down, kind of a choppy rally, and then getting an impulsive drop into a low. Silver, here's the weekly. I'd say just go with the break. I mean, really, you've got this essentially a descending triangle from 2016, December 2016. And this is a hit, what I'd call kind of a hidden support that we hit this week. That is weekly reversal support, right? You can see the low here, or December 12th. That was the weekly low. The week that started December 11, 2017. That is the weekly low bar, and the close of that bar is 16,032, and that support 3 ticks away from this week's low so far. So concentrate more on the gold pattern from here in the 1295 level. I still think that the silver, silver were out. I still think that silver will outperform gold. Okay. Don't forget about the extreme position we had with, spec position we had, assuming those who all bought into this are by now wiped out because you've already taken out all the lows. But if you can get a break up through here, 17 and change, we should be off to the races. Okay. Until then, follow the gold, 1295. All right, so remember that gold chart. Now let's go to the crude oil chart. I mean, come on, really? You know this chart. I've shown this chart in a lot of updates, and we've been looking at it for a while. I think crude is going a lot lower. Like, I think it's going to 57 bucks. I mean, this level is just ridiculous. Okay. Count 5 up, 1, 2, 3, 4, 5. You've been on this level for 3 weeks now. Dollar's been ripping, crude hasn't done anything. Sometimes you get a delayed reaction. I think that's what we're going to get here. And I'm looking lower. On the short-term chart, we've got pretty clean short-term fork. This is the same long-term line, by the way, just have it in magenta, so it's nice and colorful. But we continue to press and press and press this median line. We did it yesterday. We did it this morning, right? I mean, look at this. I'll go to a 5-minute chart. Excuse me. These are the inventories. Crude inventories came out. Should be very bearish for crude. It tanked and then it ripped like crazy, right, off this level. Now we just tanked again and we just ripped off of it in the last 5 minutes. I mean, there's obviously something here, folks. And you get below here, I think crude's done for. Okay. I think the specific breakdown level is probably 66.60. That's the January high. Right? Yeah, January high. So, if we get something like this, right? And then just there's my crude forecast. So I am short crude oil, and I think it's going to get absolutely smoked. Think about this too with I know that the relationship hasn't been all that close for a while, but it'll come back into line. And it started to, I think, a little bit. But if we look at this within the context of dollar CAD, we get this move up here and then pull back. I mean, we might have the buying opportunity of the year. It might be the trade of the year for Christ's sakes, if it's bearish as crude as I am, to buy $27.20 CAD. All right, now I said I had some interesting crude and gold ratio charts. So let's go there. All right, so crude oil divided by gold. This is a weekly. We're going back to the 2008 high, and really, really close to what I would consider massive resistance in this ratio. So, you know, think about what we just looked at on those two charts together, right? We just saw crude oil at this huge resistance, right? And we just saw gold at, you know, there's an argument to be made for the bullish thing in gold, right? With a flat pattern and 1295, okay, and the 200-day average. I mean, there's a lot going on there. So no wonder that this ratio itself has come into really close resistance. Now, I'm not going to say that we have to go up here and then go lower, because it reminds me of what I did with Euro. Remember this? The same thing with Euro back here. And we had it wasn't that one, was it? It wasn't, because I remember sitting here talking about it, and it was like we just missed it or we didn't hit it or something. So I think it was probably this one. Yeah, it was this one right here. And I was like, here we are. We're just going to go like, you know, 60 pips higher, and then we're going to be at a top in Euro, and it never happened. And instead, that was the top. So I was being like way too perfect, perfectionist type of thing, and it just obviously you screw yourself sometimes with that. So I'm not going to do that here. That's probably actually the right one right there. 18 degrees, 20 degrees, 20 degrees. So it's the same. All right. So with crude, I'm sorry, I'm on a little tangent here. Wow. All right. So with that crude oil chart to gold chart, this tells me a few things. One, it tells me that I'm probably right in being bearish crude up here. I don't know if I'm necessarily right in being bullish on gold, because they could both go down and crude could just go down a lot more. I think the bearish case for crude is a lot stronger than the bullish case for gold here. But be that as it may, this chart says that crude is at resistance, not just against the US dollar, but also against gold. And I think that's makes it even more bearish, basically, right? Let's go to the daily chart. So this is the daily chart of the ratio. And you can see this is just a channel from this. We're just drawing a channel from here back to August 2016. And, you know, nice uptrend. Okay, fine. 5 waves up. 1, 2, 3, 4, 5. Resistance on the uptrend, right? You've basically been trading between these two parallels now since the year started. So, you know, came down, support, median line, support, support. So we're at a level where we should be watching for uptrend resistance, and on the really long-term chart, we're at downtrend resistance. That's a nice combination. And again, yeah, it makes me looking to the downside in crude. We can go to a more, you know, classic interpretation of RSI here, and you've got a pretty big divergence, right? So lower RSIs since November of 2017. So this was your momentum extreme, right? You had divergence up here, you fell off. We've got divergence again here. So, you know, good argument to be made from a technical perspective that crude is about to go lower. That's why dollar CAD might be the sneaky long that is not being talked about a whole lot too. Okay, let's go to indices. We're going to start actually with the DAX. So we've been talking for ages, it seems, about this median line and this level in the DAX, and we have hit it. Okay. Jorge saying, where would you trigger the short entry on crude? Well, I mean, you can do it now if you want. This is a long-term idea, right? I'm not trying to scalp this. Like, I'm short crude through options. So, you know, it's not like a spot setup necessarily, but I would just do it. If you drop below 66.60, I would just go, you could go short. You know, I'm bearish crude. That's my market opinion. I'm bearish on crude oil. You know, there's a couple things to watch for here. If you, again, like I said before, if you traded and you broke down, and this was your first breakdown, then you'd want to be selling the first rally back into the median line, right? That would be probably the ideal setup. You know, takes a lot of patience, of course. I mean, that's kind of what this setup in Euro was like, although it didn't really do it for whatever reason, but that's what this setup in Euro is like, right? So here's the median line. You break down, hit the 20 or the 75 line, get a rally, almost back to the median line, and then it's a short, right? So that's the same idea in crude oil on this chart. All right. So I hope that helps, Jorge. So here's the DAX. The DAX is at resistance and 5 waves up. So I'm looking for a pullback, probably back to here, right? This might be another good argument for Euro to bounce, right? DAX is at resistance, Euro's at support, although the DAX resistance is a lot cleaner than the Euro support. So, you know, if we put in, I'll put in dollar Euro, right? So that it's on the same wavelength, but you can see that the Euro drop here has been coincident with the DAX rally, right? We're back in that market environment. So, the Euro decline, the DAX rally and the Euro decline. This is the dollar rally, not Euro rally. So this tells me that it's time, or another piece of evidence, right, that says we should be shorting DAX here and buying Euro. All right, what about the Nikkei? This is one that we've waited for as well for a long time, and we haven't quite gotten there. Maybe you get there on FOMC, I don't know. 22,708 is the yearly open, but for all intents and purposes, I would say that you are kind of at resistance in the Nikkei without trying to be too fine about it. You've got, you know, this is the parallel all the way back to, you know, we're talking 2009 low here. I know it looks weird there. That's because it's drawn initially on this weekly chart. What the heck is going on here? There we go. Okay. So we are there, and there. We have resistance in the Nikkei. It is time to be short the Nikkei, I think. And that would be, this supports the dollar yen idea too, right? The dollar yen is going to come off, maybe get 110.25, 50, but then dollar yen is going to come off. All right, US indices. What about those? Well, in a word, I don't really know. Not nearly as clean to me from a levels perspective as the DAX and as the Nikkei. There are a couple possibilities here, and they're kind of like the exact opposite of each other. So one possibility is that this is a bullish triangle. This is the S&P, and this is A, B, C, D. and that you're going to drop here in E, maybe test 2580, and then the market's going to turn around and go higher. Okay. The other one, and this is quite often the case with triangles when it breaks out the way that you don't think it's going to break out, is this is A, big A, this is small a, small b, small c, small d, or small d still underway, and then you get small e, and then that's big B, and then you go lower. So point being, after all of that nonsense that I just said, is that you are still in a big range. So we should still trade range, or if you are trading the S&P, you should still trade range, and then look for, excuse me, and then look for the break and just go with the break. Okay, we've consolidated to the point now where it's proper to just go with the break. Okay. Hold on here. Trying to. I want to see where the alternating leg is. 618 puts you all the way down at 2560. That's essentially the low. The NASDAQ, by the way, continues to trade within this fork as well. And if this is a triangle, A, B, C, D, this whole thing, sometimes the end of a triangle will end up as an E wave itself, or sorry, the end of the E wave of the triangle will end up as a triangle itself, in which case you'd be looking for an alternating leg of 618. So you'd be looking for this leg and this leg to relate by 618. If that's the case, then what you want to watch for today is 65.18 for support in the NASDAQ. If that holds, then I would kind of lean towards the idea that the US markets and the NASDAQ in particular are making bullish triangles from the highs that were made either in January, right, or in the case of the NASDAQ March, but with the, call it the orthodox high in January. Whereas if you slice below this level and you're back below the median line, then I would not go with that interpretation, and I would abandon it, abandon that interpretation. Okay. So that's that. Now I want to leave you with one last thing. This is the uranium ETF. This, I don't know, I was just looking through charts last night and this kind of caught my eye. So when you look at this chart, right, it looks like a big head and if you were at a high, like a market high, this would look like a big head and shoulders top, right? Well, when you're at a low, you know what it looks like? It's called a compound fulcrum pattern. Okay, it's essentially a head and shoulders, but at a low. And it's a very powerful pattern when you break out of it. The other part is that you have what I'd consider kind of a launching pattern here since February of 2000 or February 9th this year, which is you've got a head and shoulders bottom. It's extremely bullish looking launching pattern because it's also upward sloping neckline, higher right shoulder within this compound fulcrum. So you could have essentially a massive low in the uranium market. That's all I'm saying. All right. I'm going to leave that there. I've got to run. So sorry I could not get any questions in today, but we had a lot to cover and got to get ready for FOMC, right? So thank you all for your time. Have a great rest of your day and have a great rest of your week. All right. I'm going to get this up and archived as soon as possible. All right. Take care. Bye.